Last week, the United States of America raised its policy rates by 75 basis points. This is the third straight three-quarter-point increase. Rates are increased to curb inflation in the world's largest economy, which had grown to a 40-year high. What is the impact on emerging markets, particularly on low- and middle-income countries like Sri Lanka? It appears that the old adage "when the United States sneezes, the rest of the world catches a cold" still holds. Let's look at 3 areas of how countries suffer from high U.S. interest rates. Firstly, high interest rates in the United States attracts investors, who pull their funds out from emerging markets. Secondly, imports become more expensive, resulting in expanding the trade deficit. Thirdly, emerging nations push to default debt due to balance of payment crises. Let's look at each of them in more detail. An interest rate increase in the United States strengthens the US dollar. This is as foreign investors buy into US securities, attracted by its higher rates on offer now. Such investors typically cash out from risky emerging markets. The consequences are plain to see. According to JP Morgan data reported by the Financial Times, foreign investors repatriated about $50 billion from emerging market stocks and bonds in 2022. As a result, the US dollar relative to a basket of foreign currencies has appreciated to a 20-year high. Such outflows cause emerging market currencies to depreciate against the dollar at a faster pace. A stronger dollar makes imports expensive. This is at a time when commodities, particularly food prices, are elevated due to the Russia and Ukraine conflict. The increasing import cost is somewhat offset by higher export dollar revenue, particularly by the garment and IT services industries, in the case of Sri Lanka. However, despite the country's current import restrictions, over time a stronger dollar will widen the trade deficit in Sri Lanka. Countries are likely to look to implementing more import controls, further damaging economic activity. Also, increase in import-related inflationary pressure limits the ability of countries to adopt stimulus policies to help the vulnerable, for fear of exacerbating an already high inflation. And lastly, an expanding trade deficit causes a balance of payments crisis, which results in highly indebted emerging markets to default. Further, the stronger dollar makes payments on US dollar-denominated loans more expensive, another challenge for emerging market debt. Sri Lanka, Lebanon and Zambia have already defaulted on their international debts. In the case of Sri Lanka, where a record high trade deficit in 2021 and early 2022, and limited foreign inflows, compelled the island nation to default on its $51 billion external debt in April. This leads countries into a vicious cycle of credit rating downgrades, making raising required debt and investment difficult, complicating the process of their economic recovery. In conclusion, the rate hike in the United States has some very unintended consequences for Sri Lanka and other risky emerging market economies. In November, the Federal Reserve will once again meet to decide on the US interest rate. With wide anticipation for a further increase, the impact on Sri Lanka and other emerging economies will be felt further.